Congratulations. This is now the most volatile market ever. While we've had some huge intraday swings in 2008, even back then it wasn't this dramatic. We may have gone down faster in the crash of 87, but that was almost a straight line. We weren't whipping back and forth like this. The truth is we've had more 4% plus moves in the last 10 days than in any other period in modern history. You haven't gone crazy. It's the world that's going crazy. That's why tonight I want to do a special Friday edition of Off the Charts, this time with the help of Mark Sebastian. He's a brilliant technician who's the founder of OptionPit.com, as well as being my colleague at RealMoney.com, our resident volatility expert. This is one of those moments where you need to take a step back and try to look at the situation through a quantitative lens rather than an emotional lens because, wow, trading has gotten highly emotional. Even though this is the most volatile market in living history, Sebastian says the best point of comparison is, yes, the Great Recession, 2008. Now, this man is a scholar of the CBOE Volatility Index. That's the VIX for short. We also call it the fear gauge around here. And he points out that yesterday was the VIX's fourth highest close ever. The only times it ever closed higher were during the financial crisis. Makes sense. The VIX tends to go up when the averages go down and vice versa. They don't call it the fear gauge for nothing. The first and most important takeaway from that period, Sebastian says peak volatility does not mean peak sell-off, okay? Not. Meaning don't get too exuberant about today's rebound. Take a look at this pair of charts showing the S&P 500 and the volatility index back in 2008 and 2009. Back during the financial crisis, the VIX spiked dramatically in October. Okay, you're looking at the VIX here. That was the second highest close ever for the volatility index. Not long after, we got some positive data, and the S&P 500 briefly popped, only to tank again a few days later. In response, the VIX spiked again, this time climbing to its all-time high in November. Incredible. And that's when volatility peaked. But even then, it took months before the stock market could find a bottom. Volatility peaking did not equal a bottom in the stock market. Just the opposite, okay? In fact, we had some huge aftershocks that ultimately dragged the S&P 500 down 12% lower by March of 2009. If anyone remembers, this was a brutal stretch, even though volatility had peaked. What was happening during the 4 months between the volatility peak and the bottom? While the S&P 500 continued to drift lower in fits and starts, Sebastian points out that the VIX was drifting lower too. By the time we bottomed in March of 2009, it was down 30 points from its highs the previous November. That's why Sebastian's so insistent that peak volatility doesn't equal peak pain. When the market keeps beating the stuffing out of us, sooner or later it stops being shocking. Now let's circle back to the present. I want you to check out this pair of charts showing the S&P 500 and the VIX for 2020. You can see that as the S&P plummeted, the VIX has moved up pretty much in a straight line, okay, before closing last night at 75. If we zoom in on the action today, even as the market soared and the volatility index closed down 23%, it's still up huge over the past month. Despite recovering most of yesterday's losses, we haven't given back as much of the risk premium. The VIX was at 54 on Wednesday. It's still 58 now. That tells Sebastian what? Yes, that the smart money remains scared. If this meltdown is anything like 2008, then he thinks we have some aftershocks coming. What does an aftershock look like? Okay, after opening strong this morning, the S&P 500 briefly pulled back hard, erasing nearly all the gains. Yes, a great trading moment. While the S&P was still up oh so slightly, the volatility index didn't erase its losses for the day. It surged to a new intraday high at just under 78. Then the market rebounded hard and the VIX came back down. But for that one brief moment, the fear gauge was actually up versus yesterday. And yesterday was the worst day for the average since the crash of 87. That's not a good sign for the bulls. It tells Sebastian this rebound is built on shaky foundations, just like the last rebound and the one before that. And I keep telling you, the last half hour of today is what I call the definitive shaky foundation. I got one more pair of charts for you here. This is the volatility index on top and what's known as the VIX volatility index on the bottom, which measures the volatility of the VIX itself. What's wrong with this picture? Even though the volatility index went lower today, the VIVIX, that's what they call it, the VVIX, the VIVIX, well, what did that do? It kept surging up more than 10%. That means there's a lot of money betting that the fear gauge will continue making big outsized moves like it did yesterday. In other words, the VIVIX is saying that this period of intense volatility might not be over. The volatility index could go to new highs, and when the VIX goes up, the S&P 500 almost always goes down. What does he need to see before he can get more bullish? The VIVIX needs to start coming down, and the VIX needs to stop spiking every time the S&P experiences an intraday reversal. Unfortunately for the bulls, Sebastian says we just aren't there yet. which is why he expects the averages to make fresh lows at some point, probably next week even, which is why it may pay to do some selling if we get any strength on Monday, or even if we come in flat, not down 1,000 points, then we have to reconfigure. The bottom line, the chart is interpreted by Mark Sebastian, our VIX expert, suggests that today's move was, yes, the definitive dead cat bounce. Sooner or later, he thinks the market will actually be worth buying, but he's betting there'll be more pain before we find a bottom. These charts verify that. Greg in Mississippi. Greg.
Hey, Professor Cramer, thank y'all for taking my call.
Of course.
My stock is United Rentals, URI. I see their equipment and construction sites everywhere. The price to earnings is really cheap, seems like. I bought in a couple of days ago, 70 shares at $98. How will the coronavirus and the oil industry issues affect the company?
Okay, this is, Greg, a stock that you buy when you get an economic boom. If you believe that there's going to be a recession, you sell this stock 9 ways to Sunday. I happen to think that that's what I regard as too binary for me. You sound like someone who's willing to take a risk. This has plenty of risk to it, obviously big reward, but too much risk for me. Let's go to Steve in Washington, please. Steve.
Booyah, Jim. Thanks
Booyah.
for what you do to help our fellow Americans.
Doing my best. What's going on?
Got $100K in cash, looking at Prudential, down about 40% from last year's high, around 106. Just what's your position on it, and regarding the dividends and any other suggestions with the cash? Thank you again, and appreciate
Prudential long term, I've always liked it, but this doesn't seem like the old Prudential, frankly. I wish they'd come on the show. It just seems so much more risky than it used to be. Travelers is a less risky one in that department, even though that stock's not doing that well. Steve in California, please. Steve.
Jimmy.
Yeah.
Hey, first, I just got to tell you something. I believe in you, and I know there's a lot of chaos out there, but I think you need to hear that.
Thank you. Thank you.
We're gonna get through this mess
You
together.
bet we are. No, I have no doubt whatsoever. We're going to get through it, and we're going to get through it whole. What's going on?
Yes. I called you over the summer when the markets were kind of flat, and I told you I have a lot of growth stocks, but I didn't have any dividends. And you blessed me buying Starwood, and I have been buying it from the top all the way down here. And we've come a long way down, and it's been painful.
Yes.
You talked about accidental high yielders. That was a high yielder to begin with, and now we're over 10%. Are you throwing in the red flag on this one?
You know what? I listened to Barry Sternlicht, who's the CEO, talk this morning on Squawk Box. When there's really something wrong and it's not going well, you don't go on Squawk Box and say it's going right. Barry Sternlicht is a seasoned investor. I can't own stocks, but I've got to tell you, this is one accidental high yielder stock that I think is actually going to work out okay. He's a straight shooter, Barry. All right, listen. This is the most volatile market ever. And our guy, Mark Sebastian, along with some other people I know who are very familiar with the VIX gauge, say, listen, do not get complacent about this rally. If anything, it was phony. He believes that there's more pain before we bottom. I'm not going to disagree. Remember, this is about illness, and it's about lethality. Buckle up. Much more Mad Money ahead, including my exclusive with DocuSign. Now, there's a hot one. As more employees work from home, is the company uniquely positioned to benefit? Then there are tons of reasons people have to sell. But looking for a reason to buy, I'm going to tell you what you should be focused on. And all your calls are rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. We are trying to make sense of things for you here tonight in the face of this incredibly difficult but panicky tape. I like to buy hysteria, not sell it. I like to buy panic, not sell it. We don't advocate panic because it's not a strategy. There are two kinds of companies in the blast zone. The ones that are at risk and the ones that are really at risk. What bounces best? That's what you must be thinking about at this point. What a day. We have your back and we'll get through this together.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.